Good afternoon. This is Kathy Neifeld, one of the 4 partners at Agency One. Together with Ed Lesher, Dennis Bartos, and Gonzalo Garcia, I am honored to welcome you to the 2020 Agency One Annual Advisor Conference. This is day 3 of our Agency One Virtual Advisors Conference. Thank you for joining us. For those of you who joined us yesterday, we hope you found value from Teresa Easler's session on Are You Camera Ready? You will see that today I am in an orange sweater as opposed to my white blouse, so I am learning along with all of you. If you missed yesterday's session or our opening speaker on Tuesday, Ben Nemtin, who spoke about 5 steps to make the impossible possible, you can access recordings of these sessions on the conference website. We have a large number of people that are joining us for the first time, so I am going to once again provide the introduction which has previously been shared. If you have already heard it, please bear with us, and I promise we will revise it for next week's sessions. Almost 30 years ago, when Ed and Dennis and Gonzalo were with the Potomac Group, they started offering these educational, networking, and idea sharing conferences for the benefit of the advisors that they worked with. 28 years without a miss, these conferences were held in person from our nation's capital. Agency One's intention was to have this meeting in person in Washington, D.C. this past April. And of course, we all know what happened. For those of you who have attended our conferences in the past, thank you for being with us today. For those of you who do not know us, we hope that this experience will give you some takeaways that will help you grow personally and professionally, and that it will expose you to the culture, capabilities, and professionalism of the Agency One organization and family. Our format this year, as you would expect, is a little different now that we have been forced to take this meeting into a virtual platform. With that said, as is our custom, we did not cut any corners on content and opportunities to learn and share. In fact, we may have gone overboard. We will have content for you during the entire month of October on Tuesdays, Wednesdays, and Thursdays during the noon hour Eastern Time, and a smattering of 30-minute workshops at the 3 p.m. hour Eastern Time. The entire meeting is being hosted through an attendee hub where you will have the entire agenda, live streams, virtual meeting rooms, and a virtual exhibit hall for our insurance company partners. The exhibit hall is open each Wednesday from 11 a.m. to noon Eastern Time. I hope that you took some time yesterday to visit with them virtually through the attendee hub. Many of our insurance company partners are providing different content and offerings on each Wednesday, so please be sure to visit their booths for additional information about what they are providing. Without their support, this event would not be possible. These sessions are open to everyone, and I would encourage you to invite others in your network to register and join us. There will be a number of Agency One 100 advisor only sessions, which are by invitation, including a virtual cooking demonstration, as well as a hosted dinner and fun show, both family friendly. Finally, on Wednesday, October 28th at 12 noon Eastern, we will be hosting our idea sharing contest. 4 finalists will be selected to present their winning ideas for the benefit of the entire group. These 4 will be picked by a group of judges to present on the 28th, and the winner will be picked by their peers during the session. In order to have your idea considered, please submit a 3-minute or less video of you sharing your idea by October 12th. There are only 4 days left to submit your idea. The 4 finalists and presenters for the October 28th session will be announced the prior week. Any idea is a good one. It could be a sales concept, a practice management idea, a networking idea, anything. So please grab your phone or tablet and record something for submission. Should you have any questions, please let us know, but more importantly, please share and have fun with it. Without further delay, just a couple housekeeping items. Number 1, all attendees will be on mute. Number 2, please submit questions through the chat function in the attendee hub. Number 3, most of the sessions will be recorded and a link to the recording will be made available after the session. And number 4, please don't forget to complete the session survey after each session. Again, I would like to thank you all for being here today. And more importantly, I would like to thank our sponsor for this presentation, AIG American General. To introduce our speaker, I would like to invite Steve Burns, Regional Vice President, Mid-Atlantic Territory for AIG American General, to say a few words and introduce Ed Renn. Steve, please take it away.
Thank you, Kathy. Much appreciated. And a big thank you to Agency One, who is a true partner of ours, and they're really the best at what they do. So if you are here at their virtual summit, you are definitely in the right place. It is both mine and AIG American General's honor to sponsor today's session. Edward A. Renn is a principal in the international law firm Withers Bergman LLP. Ed focuses on domestic and international private client matters. Ed's practice includes U.S. and international estate planning, income maximization strategies, FLP and LLC planning, wealth preservation, business succession planning, international tax planning for entities and individuals, trust structures, estate administration, and planning for single and multifamily offices. Ed frequently utilizes sophisticated life insurance strategies in both income and transfer tax planning. Ed is a frequent speaker and writer and has co-authored several books on estate planning. Today, Ed is going to discuss opportunities for wealth planning in the face of proposed Democratic tax policies. So with that, I will turn it over to Ed.
Thank you, Steve. Happy to be here. And I'd like to thank the folks from Agency One for making this possible. It's a pretty exciting time to be a tax lawyer because change is always interesting in our practice, and as it is in the life insurance industry. And I think the Democratic proposals present some real opportunities for us as professionals, and they present some real challenges for our clients. So it's going to be interesting to see how this all goes. This is popularly being referred to as the blue wave, and as of this morning, I'm told Biden's chances of being elected and actually having the requisite Democratic majority in the Senate is more likely than it has been at any time during the course of this election. So we don't know exactly what's going to happen. And it's also possible that everything we're talking about today gets moderated, even if the blue wave does take place. But we're going to share with you today the best information we have as of October 8th, 2020. And we're going to keep in mind that these proposals do keep changing. What our clients really need at this point is a lifeboat. They need a plan because, as we're going to see in a little bit, there are significant changes in the tax world coming, and it's going to impact on their net worth and in what they can keep in terms of their W-2 and their income tax side earnings. So likely most of your high net worth clients need to do some planning, and they need to start it now. The administration is going to take office 104 days after the election day. The inauguration is on January 20th. There's only 59 days from election to the new year. And the reason that's important is I've seen press reports out there suggesting that no tax bill could be effective before January 20th, that you'd need the president in office and a new Congress sitting. That's not the case. We have at least 2 examples in our lifetime of significant tax changes retroactive to January 1 in the year that the presidents were elected. It happened under Clinton, it happened under Bush. And in those cases, tax acts were in May and in August respectively, and they went back retroactive to January 1. So it's really 2020 that we have a chance to get this planning done. And, you know, already my calendar's pretty booked. I can still take clients, but there's going to be a point in time when really good clients are going to have to just be told they have to go somewhere else. And I think that's going to be true not just at Withers, but it's going to be true of most of the boutique tax planning shops. So it's important that if your client doesn't have a relationship or they need particularly bespoke planning, that we get it started sooner rather than later. Okay, so let's start with a quick review of the current tax regime. There's really no way to compare Biden to Trump because Trump's proposal is basically the status quo. What Trump has proposed is maybe an additional tax deduction on middle income earners, and he's proposed perhaps rolling capital gains back from 20 to 15%. But he doesn't even seem to think there's much credibility in those proposals. If you think about the fact that we're probably going to have a deficit this year that approaches our GDP, you can understand why tax cuts are not going to be real popular items for a number of years to come. So ordinary rates, right now we go from 10 to 37%, with the top rate kicking in for 622 for married filing jointly and 518 for single taxpayers. Capital gains rates, for most of our clients, they're 20%. There are lower brackets if you're fortunate enough or unfortunate enough to be in them. And most of our clients are paying the net investment income tax, the 3.8% Obama surcharge. So the real capital gain rate or qualified dividend rate ends up at 23.8%. On the estate tax side, you guys know all of this as well. The exemption is currently 11.58 million, and it's tied to inflation. So basically, a U.S. couple has $23 million of exemption to use. The estate tax rate is 40%, and it's basically flat. There's no progressivity in it. As soon as you hit the estate tax or gift tax rates, you're paying at 40%. There is, as you all know, a law that says that in 2026, that $11.5 million of exemption is going to be reduced back to $5 million plus an inflation adjustment. Trying to guess where inflation is going to go isn't the easiest thing in the world, but it's probably, if we get to 2026, give or take $200,000, it's going to be around $6 million bucks, unless we get some significant inflation into the system. The fourth point here is important for you to remember if you have clients in this situation, because it's really a use it or lose it potentially. If you've got somebody who's died and become a widow or a widower in the last 5 or 6 years, you've got the deceased spouse unused exemption, or it always sounds like you're calling a pig, but the DSUI amount, as tax lawyers like to refer to it. And that's the portability of the gift and estate tax exemption. If dad died with $11 million of exemption, and he only had $2 or $3 million of taxable events, the rest of that exemption can be ported over to mom for her to use. And in a time when exemption may be going away, that portable exemption is very, very important. We have indications that at least as to 2026, when the exemptions roll back by about 50%, the DSUI amounts would be preserved and made whole. We're not quite sure how Biden's going to treat it, but it would appear that very well may stay intact. But there's also some ordering rules. So in a funny way, if we do gifting, we're going to gift the DSUI first. But if you've got clients that, otherwise you might not have filed the 706, and that's what you have to do to get the DSUI, you actually have up to 2 years after date of death to do that filing. You probably want to do it, because right now, when you're thinking that everybody's got $11.5 million of exemption, why do we need to pay somebody to do the return? If that's going to go away, the DSUI may be very, very, very valuable. All right, Biden's proposals. On the income tax side, nothing all that shocking. He's going to restore the top tax rate to 39.6%, which is what we had under TCJA prior to 2018. Interestingly, though, where he's going to start that rate is significantly lower than it used to be. It used to kick in about $200,000 higher for married filing jointly. One of the surprises and one of the things that I think folks haven't really gotten their hands around on the income tax side is that he's going to cap itemized deductions at 28%. So if you have a mortgage interest or a charitable deduction, it's only going to reduce your tax by 28 cents, even though you're in a 39.6% rate. So you're effectively going to be paying, your deduction is not going to shelter a full dollar of tax. He's also talking about reinstating the PEAS limitations, and we had those right up until TCJA for a while. That's the idea that once you go above a threshold, and though Biden hasn't made it clear, $400,000 seems to be his threshold for most things. So once you make more than $400,000, 3% of that income above $400,000 would offset your itemized deductions to the extent that you're always going to get at least 20% of the deduction. So if we have $1 million of income and we're a $400,000 level, we have $600,000 of excess income subject to PEAS. That's $18,000. If I normally would have had $40,000 worth of deductions, I'm only going to have $22,000 of deductions. But the income tax charts are relatively straightforward. Capital gains. This is perhaps the one of the 2 or 3 scariest proposals if you're a high wage earner. An ultra high net individual is going to be looking at a 39.6% capital gain rate. That's up from the 20% we have now. You will still have the 3.8% net investment income. And so the total rate for most folks, most of the time, is going to be 43.4%. There's some lack of clarity as to whether once you reach the $1 million, you pay it automatically, or if you had $900,000 of an earned income and $250,000 of capital gain is your first $100,000 of capital gain, 23.8, and the last 1.5, 43.4. Again, not a lot of guidance here. The Biden campaign has not done a great job of actually giving you the tax specifics on their website, but this is what is out there. And for most of our clients, most of the time, there may be some nuance, but they're looking at a 43.4% capital gain tax. The estate tax. This is really something that high net worth clients should be very concerned about. It's going to present a lot of opportunity for planners and life insurance professionals for 2020 and likely beyond. The big one, I think, is Biden wants to eliminate the step up in basis. So right now, if mom or dad bought a business or created a business from the ground up and their basis in the business was $1 and its fair market value was 100, it would be included in their estate for estate tax purposes, and then you'd pay estate tax on that, currently 40%. And in return for that, you'd get a step up in basis. So the dollar asset would now be worth 100. And if you sold it for 100, there would be no capital gains owed. It's not entirely clear whether Biden's proposing mark to market, where you would have to pay capital gains on death, or it seems more likely from most of the presentations that he's talking about a carryover basis. So if dad paid $1 for it and son inherits the business still has a basis of $1. That at least allows you to control the tax event. Second big blow on the estate tax side would be reducing the exemption from the current 11.58 million down to 3.5 million. It's possible that they'll moderate it at the 5 million adjusted for inflation, but it appears that he's aiming for $3.5 million. And so effectively an individual who gives up the $8+ million of exemption that would result in this reduction, they're going to pay an extra $3 million the family's going to pay an extra $3 million of estate tax. So this is worth about $6 million to a married couple. Biden's also talking about raising the estate tax exemptions to 45%. Now, Joe's not a spring chicken, and I think it's interesting to look at what Camilla was talking about when she was running for president. She actually had an income tax rate as high as 70% and an estate tax rate as high as 77%. So if you think there's going to be any moderation or any move to the center, if Joe doesn't make the full term, at least back in December, January, and February of 2020, Camilla was not closer to the center. There's some other tax initiatives, and I'm going to go through these pretty quickly. Some of them are important, but there's a lot of material here, and I want to talk about ways you should be talking to your clients about dealing with some of these issues. One of the big tax initiatives is to raise the corporate income tax rate on C Corps back up to 28%. Remember, we used to be at 35%. TCJA took us down to 21%, which made us competitive with most other industrialized nations. When we go back up to 28%, we're going to be the second highest Western corporate tax rate out there, probably impacting on our competitiveness. He's also talking about bringing back a 15% minimum book tax. It's on significant wealth. It's not a great tax. People aren't real happy about it, but it's not an alternative minimum tax on small corporations like we had before TCJA. There's a $100 million threshold here. In the last few weeks, he's also talked about an additional 10% corporate surtax, and that would apply for any company that manufactured products or rendered a service abroad that was sold into the United States. So if you run out of US toilet paper and you import Canadian toilet paper, you'd effectively pay that 10% surcharge, which raises the rate up to 30.6%. One of the things that's going to impact many of you in the audience, as well as your clients, is this change to Social Security taxes that Biden's proposing. Right now, you pay the OASDI tax on the first $137,700 of income. You, in theory, pay 6.2%. Your employer pays 6.2%. If you're self-employed, you pay the whole 12.4%. But it stops. Under Biden's proposal, there's going to be tax up to $137,700, or taxable wage-based changes every year, so it'll increase a little bit. And there will be a donut hole between taxable wage base and $400,000 where you will not pay OASDI tax. The scary part is OASDI tax will kick in at $400,000 and will be subject to every dollar of earned income from compensation that you have over that. Anything that would be subject to Social Security tax will attract that combined 12.4% tax. So many of you are self-employed or you're working through flow-throughs and you're picking up that income. You're basically going to reduce your income by 12.4% for everything over 400. It's a big adjustment and a lot of people haven't focused on it. Other proposals that will impact your clients is the elimination of like-kind exchange treatment for real estate. We've only got 1031s for real estate left, but we have a lot of clients that are on exchange 10, 11, or 12. They're waiting to die, get the step up in basis and get out. Well, there's not going to be a step up in basis at the end of the day. And ultimately, if they get out of the current property, there's not going to be the opportunity to go into another property. We're talking about doubling the GILTI tax on foreign income to 21% from 10.5. Could do a webinar on that, but just be aware of it. If you have clients with foreign source income, they're facing a significant increase in tax. Good news, perhaps, is he hasn't come out and said it, but Biden's hinted that there's going to be a restoration of the full state and local tax deduction, not the $10,000 cap we have under TCJA. So that would mean your local property taxes, your state taxes, if you're taxed in a couple of jurisdictions, all of your state taxes would now again be deductible, but subject to that 28% cap. So if you're earning $1, that isn't going to shelter $1 of income. It's not going to shelter 39.6. It's going to shelter 28. One of the other proposals out there that will impact many of your clients is this idea that pre-tax 401k salary deferrals are going to be replaced by a 26% tax credit. And the press out there is really wrong. They're really not thinking about this right. They keep talking about the idea that a high-end earner defers $10,000 and gets a $3,700 tax deduction. It's not a tax deduction, it's tax deferral. You're paying tax on the backside when you pull that money out. And so what you're going to get now under the Biden proposal is you're going to put in that $10,000, you're going to get a tax credit that's worth $2,600. So there's going to be a tax, 13%, on monies that you go ahead and put in a 401k if you're in the top bracket. Now, obviously, a couple of things are going to happen. People are going to use Roth, and people are going to eliminate 401k features. And for smaller, high-earning groups, they're just going to convert to profit-sharing plans or DB plans, something along those lines. But what this is supposed to do is, in the example, somebody in the 10% bracket defers $10,000 now. They only get a $1,000 tax benefit from it. By having a 26% credit, they'd get $2,600 of benefit from it. And if that, in fact, was greater than their tax bill, it would be refunded. We're also looking at a financial transactions cost, which would basically be every time we buy or sell a bond or a security on an exchange, and it's likely going to impact mutual funds as well. The credits I really kind of want to go through quickly because I want to cover more material with you. But the ones that are probably the most interesting is something we have very little detail on, the 10% Made in America tax credit, something he's proposed in the last couple of weeks. It's the idea of reopening Rust Belt factories, modernizing assembly lines, bringing more manufacturing jobs back to America. It's great in theory. A lot of the economists aren't certain that we can do. The problem with modernizing a factory in America today usually means we're bringing in more robots and eliminating more real jobs for people. But that said, I think everybody would say it's probably a good idea to bring some production home. He's going to expand the new markets tax credit, which we currently have out there. Again, a manufacturing communities tax credit. Expand the child tax credit to $3,000, create a credit for starting up a 401k plan, lots of credits available for alternative energy or electric vehicle credits. So, putting solar panels on your house or buying a Tesla might become a tax intelligent decision. For most of your kids, the idea, and your clients' kids, the idea that there's first-time home buyer credit, giving you $15,000 in cash is real attractive. The other credits are pretty much what they are. Most of them, more of a move to refundable tax credits. So the idea that if the taxpayer doesn't actually own tax, the tax system will give them a check. This is just basically a quick review. We're basically talking about going from 37% to 39.6%. We're talking about top corporate rates going from 21 to 28%, with 30.6% being the bracket for offshore. We're going to limit the value of tax deductions under Biden's proposal at 28%, whereas right now you get a dollar for dollar deduction. Estate tax exemption going from 11.58 to 3.5. Estate tax rate, at least initially, only going up 5%. And maybe the scariest thing of all here, the elimination of step up in basis. So what are we going to do? Well, you know, it comes at a time when we've had a very busy 2020, and we all know that. But we really have a couple of things going for us when we're trying to do this planning, particularly on the estate tax side. We've got depressed asset values from COVID-19. I mean, remarkably, the markets did a significant dip in March, but that's all back, and we're actually in positive territory in most sectors. Maybe energy is the exception to that. But in terms of real estate, in terms of closely held businesses, those assets are significantly depressed and are subject to significantly greater valuation discounts than we could get before. We've got incredibly low interest rates. We all know that. We look at AFR, we look at the 75-20 rate, we look at what government bonds will actually yield and what our clients can get from their munis and their bond portfolio, and we realize interest rates are really low, and that's important because it's a big tool in a estate planner's toolbox. And ultimately, we've got those possible tax increases and the disappearance of the exemption that we already talked about. So the best two assets to plan with right now for the ultra high net worth families tend to be real estate and closely held businesses. COVID has certainly put a lot more of a risk premium into these types of assets. For a business that I would have expected to get a discount of 30 to 35% for in January, I'm probably getting something in the mid 40s now. So it's basically been a 50% increase in the discounts that are available out there. And the discounts are for lack of marketability or for lack of control. So these can typically be created by taking an S Corp or an LLC and recapitalizing it into voting and non-voting stock. The non-voting stock is going to get all the discounts. Publicly traded assets have recovered from that first leg down, and you know, I hope for the sake of all of us, there really isn't a second leg down. A chart of interest rates going back to 1997, and you can just see the trend. It's nothing that you don't intuitively know. So what are we going to do now? We've got to go ahead and draft a trust, get something in place for the client, because there's going to be very little time to do much after the election. The other thing that is interesting is when you think, you know, you just assume that on election day or the next day you're going to know. Most of you have been around long enough to remember the hanging chads of 2000, where it was nearly 6 weeks before we knew who the president was. And I mean, the Electoral College doesn't meet until mid-December. Both parties have spent a lot of time hiring lawyers and training lawyers on how to go in and dispute election results. I am going to be very surprised if this election is close, if we know with any immediacy as to who won. So, you know, the idea of, well, we have almost 2 months to plan after the election. Well, maybe you don't. So it's really, really important to think about it now. We have some options, and we're going to go through them when we look at the slides. We can create the trust now and not fund it at all. We can create the trust now, gift 10% of the assets in, and typically fund the rest either with a note and move it all in now with a 90% note. We'll get into it. Or you can just simply go ahead and gift your children a note and be done. If the blue waves hits, you're going to want to get this thing funded. And if you've been using notes, you're going to want to cancel them so that we can accelerate the gifts. But in reality, and don't miss this, your clients can say, oh, why do I have to do this now? They're going to have to do it in 2025 anyway. And if they move the assets now at the times when valuations are lower, so the appreciation can grow outside of their estates and they're growing for a longer period outside of the estates, the more effective this tax planning is going to be. Now, many of you are probably saying, yeah, okay, but I represent clients with real money, so moving $11 million is great, but they're still going to have a sizable estate tax. And that's okay, because one of the things we want to do with that $11 million we move is we want to use that trust and that funding source to buy some life insurance. Now, There's lots of ways to do this, and I'm not suggesting this is the perfect technique for everybody, but one of the most common and most popular ways to do this planning is to use a grantor trust or an intentionally defective grantor trust. Only lawyers would take the best technique around and label it intentionally defective. But what that really means is the grantor is going to continue to be responsible for the income tax, but the assets are outside of his or her estate and grow estate and gift tax free. So that's the defect, the idea that it remains behind for income tax purposes. We get them out of the estate, and that's very, very valuable. Now, what we sometimes do in these scenarios is if we had a client that had a lot of assets that they wanted to freeze the value on, we might use the $11 million as a gift, or more likely for clients that are trying to hedge, is this election result really going to happen? Maybe I'd give $1.2 million to the trust now outright, and the rest would be sold with a note. Now, because the grantor is responsible for the income tax, it's very much like you selling yourself a security. It's not a recognition event. There's no tax consequences to this. If I sold my family business to my son outright, I'm going to pay capital gains on any growth we have in that business. If I sell it to a grantor trust for his benefit, no capital gains get paid, and he gets a carryover basis. People used to say, but now he's got a carryover basis, and if you just died owning it, Ed, he would have gotten a step up. And that's true. But under Biden, you're not going to get a step up. So the one attack on grantor trust planning that needed to be factored into the analysis, in my mind, is no longer a viable option. So the idea here is these trusts can hold securities, they can hold businesses, they can hold real estate, and they can hold big life insurance policies. And if they're holding a big life insurance policy, the nice thing is the business, the rental stream, the dividends, the bond coupons, whatever else the trust owns is there to pay the premium. My clients typically don't mind insurance at all. They mind insurance premiums. So we're giving them a mechanism that for more wealthy folks, crummy powers aren't going to cut it anyway. We're giving them a mechanism that will allow you to buy significant life insurance inside of this factor. Now, distributions from the trust during the lifetime of the grantor aren't taxable to the beneficiaries because mom or dad or whoever's setting up this trust is going to pay the tax. There is no income tax cost to the recipient, so this is not a complex trust. It becomes that on the death of the grantor, but right now it's really like a glorified Roth IRA. It works really, really well. For clients with less than $50 or $100 million, we're typically providing spousal access to these trusts. So the trust would be set up for my spouse and my 3 children, and my spouse would set up a trust with $11.58 million in it for me and my 3 children. We do some things that make the trusts different, so we don't have a mirror trust doctrine issue, so that would invalidate the gifts. But realistically, by doing that, we gave away $23 million, but while we're both alive, we're both beneficiaries of those trusts. And as long as the trustee sees things our way, or if we're the protectors, we have the ability to remove the trustee if they don't see things our way. Effectively, we have access to all that money. If you've got a scenario where clients really are only worth $20 or $30 million and they really want to go ahead and use up their exemption, it's different than the rules used to be, right? We used to always tell clients, gift split, gift split, gift split. Each of you make half the gift. In this scenario, we would probably, assuming that nobody's used any exemption, we'd want one spouse to make the transfer and the other spouse not to participate. That way, the spouse that didn't make gifts would have a $3.5 million exemption left under the Biden regime. So we'd get effectively 11.5 plus 3.5 or $15 million of exemption for the family. The other thing, don't forget, if you can also use a floating spouse definition in these documents. So it's the wife I'm married to at the time of my death. You've got to be careful about how you use that, but it's an interesting tool for some situations. In most of these gifts, if you're gifting hard to value assets, you want to go ahead and make sure you're doing them with a Wandry clause. You want a defined value clause that says, my intention is to give away $11.5 million of value. And if when you value this IRS, you decide it was $14.5 million of value, well, the other $3 million never really transferred. It stayed in my estate. So that's worth thinking about. But this is a relatively simple picture of a grantor trust. The idea that mom or dad transfer that $11.5 million into the trust. It's available for the spouse and the descendants. Typically, these are dynasty vehicles. Just about any state we can get 100 years. If the client is in the right state or is willing to shop for their jurisdiction, we can get them perpetuity. These trusts can go forever. We would typically, in any gifting scenario, not just for grantor trusts, we do it for BDITs or for preferred partnerships or anything else we were going to use. You're going to recapitalize an S Corp or an LLC into voting and non-voting interests. Typically, if I have 100 shares, when I start the day, I end up with 1 share has the vote and 99 shares are non-voting. I'm going to be able to discount those non-voting shares. Those are typically what we're going to gift. And those discounts can be significant. They're discounts that are much higher than we've seen in the last decade. So again, the key takeaway here is the 38 BIP interest rate for midterm AFR. If we're going to do a gift sale, we're only going to be the hurdle rate. The rate at which the asset has to perform to make this gift tax efficient is 3/8 of 1%. And that's for up to 9 years. And increasingly, that was always the rate people used. Up until 2 or 3 years ago, it was always midterm AFR. Now, long-term AFR, which is just a little more than 1%, and you can take the note out 30 years, that's pretty compelling too. All right. So when we use life insurance, what are we going to do here? I mean, it's really very, very simple. We're just going to use the assets that we put into the grantor trust to fund the premium. In this example, we were going to buy a policy that had about a $205,000 premium on it. It was about $15 million of insurance for somebody in their late 50s. They were non-smoking. They were not the tip-top rates, but I think we assumed they were preferred. But the reality is, that $11.58 million asset in the company is going to generate a lot of income. And that income can now be used to service that insurance premium. To the extent that there is a need for more insurance, the trust can buy it and hold it. Multi-generational, GST has already been allocated to it based on the gift. It's a fantastic vehicle to hold life insurance. So what have we actually accomplished here? If we've just given away the $11.5 million, we've saved the family $3 million. If we've given away both exemptions, closer to 6.4. If they've done more, and by that I mean they've given away 11.5, and then they've sold another $100 million of assets to the trust. And remember, the sale does not trigger any capital gains. It does not trigger income tax. But basically, you now owe the note to dad, and dad's going to pay that note at get interest at either 38 basis points a year if we're going to pay it off in 9 years, or maybe 1.12, something like that, if it's going to be a 30-year note. And we can structure it in such a way that it's partially amortizing or wholly amortizing or interest only. That's really part of the planning we do with the client when we're sitting there analyzing it. But you've been able to freeze that value. So you've gotten maybe a 40 or a 45% discount. The exemptions are going away. The estate taxes are going up, but it's out of mom and dad's taxable estate, and it's in a multi-generational vehicle. All the appreciation after the transfer is free of transfer tax. And so, you know, what we're looking for, what's the rocket fuel, is undervalued assets with significant appreciation potential. That piece of land that's, 300 acres at the end of the highway exit, that for 10 years, Dad's been saying that's the next great tech park in our part of the state. That's the kind of asset you ideally want to transfer here. You don't want to move a bond portfolio. You want to move something with significant appreciation in it. The minority and marketability discounts are huge. The one footnote I'd throw out here, 30 years ago, we might have considered taking a stock portfolio, wrapping it in a family limited partnership and gifting that. The IRS has been pretty relentless in that space. If you're going to do FLP planning, you can have some publicly traded securities in it, but you also probably want to have some real estate and some closely held business assets. It's not, take $100 million of Dad's single stock position, wrap it in a partnership and gift it the next day. That's probably not going to work. A great part of this planning, and sometimes we need to remind our clients about this, is the creditor protection they get. Because when they don't own the asset anymore, when the asset is now held by their grantor trust, it's not theirs to lose if they get sued. And if the trust has been drafted properly, the asset's protected from the children or the other beneficiaries' creditors. And, creditors really come in three forms. They're tort creditors, somebody who you hit in a motor vehicle accident, or somebody who has a slip and fall in your house, or somebody that you punch in the face. Those are all tort creditors. Contract creditors, you made a bad business deal, you entered into a real estate development that didn't go well and ultimately got foreclosed on. Those are sort of the contract type claims. And, my clients all tell me none of their children are ever going to be sued for torts, and they're never going to be sued for contract claims. So I always shake my head and say, yeah, that's right. And then I talk to them about the third creditor, and that's the in-law, that daughter-in-law you don't really like, that son-in-law that you think has an eye on your bank account when it'll eventually fall down to your daughter. Those sorts of folks, and almost all of my clients are worried about those creditors. In a properly drafted trust eliminates the need for the prenup, at least to inherited assets, and provides significant protection whether they're sued for tort, contract, or in a divorce. So sometimes that really has a real appeal and will put a deal over the top. They're convinced of the tax benefits to a point, but they're looking for more protection. They're looking for more certainty. They're worried about more than tax issues in their lives. So creditor protection sometimes gives you the ability to push that one over the top. It's also a great attribute of life insurance. So typically, you can also provide a lot of flexibility in these trusts. The the spousal beneficiary can be the protector, who's the person that can remove and replace the trustee. And typically, you can have distribution or investment advisors in documents in probably a dozen states now. And the one other nice thing about grantor trusts are typically they come with a swap power. So if at the end of the day, Dad had high basis assets and he was on his deathbed, and there were $10 million of low basis assets in the grantor trust, pre or post Biden, when we think we'd get a step up, $10 million in Dad's estate is going to attract the same estate tax no matter what his basis in that asset is. He would swap a high basis asset into the trust, take a low basis asset back, pay the same estate tax, but now the capital gains tax that would be owed by the grantor trust has been significantly reduced because all that gain has been wiped out. So let's talk about income tax planning. What do we want to do to actually accelerate steps for income tax planning? Typically, we want to pay bonuses this year. We want to accelerate income this year. If your clients have installment agreements, they may want to put a little incentive on the table to have their debts paid this year rather than in future years. If you're going to sell a capital asset anyway, if you can get it done in 2020, the capital gains taxes are going to look a whole lot better. One of the things to keep in mind is, in most cases, qualified opportunity zones are going to be a problem under a Biden regime because our clients in 18, 19, and 20 deferred 20% capital gains, and now they're going to be paying 39.6% capital gains. It's unfortunately all or nothing, but it's very easy to trigger the tax inclusion in a qualified opportunity zone investment by having an inclusion event. And that can be as simple as transferring the asset to your spouse. What that means is you'll pay tax in 2020 at 23.8%, but you've also given up that 10-year hold period with the deferral and in the 10 and 15% basis bumps at year 5 and year 7. So if you've got a qualified opportunity zone investment that you really think is going to be a 10 or a 20 bagger, you probably pay the higher tax in 2026. If this thing is proving to just be a typical real estate investment, you're going to grow at single digits. You might want to do a time value analysis to figure out whether or not you want to trigger that tax. You want to postpone, you want to accelerate your deductions generally. Charitable deductions are going to be less valuable because they won't offset the full dollar you give. They'll only offset 28% of the tax on that full dollar you give, or 28% on that dollar. You want to maximize your retirement contributions. You very well may want to do a Roth conversion this year. I mean, the reason why that's not actually on the slide is after the Secure Act, I'm not really convinced that going through the cost of doing a Roth and then only being able to have Gen 2 or Gen 3 hold the asset for typically 10 or 11 years is worth it. But that's out there. And you might want to think about, if you're taking more compensation than you need to take, and you can take money either as rental payments or as dividends, you might want to consider that to reduce your OASDI tax. The other thing I think we touched on very briefly is Biden's trying to eliminate 199A. So that would be capped at $400,000 for everybody, not just doctors and lawyers. So many of you probably had the advantage of having that 37% bracket taken down to 29 and change for the last year or two. That is going to be in danger if we actually get the Biden proposal. So there are real changes on the horizon. There are real opportunities here. Clearly, your clients are going to need more life insurance to handle their estate tax liabilities. They need to look at life insurance as a way to invest their money going forward. A good cash value policy or a PPLI policy certainly will look very, very good when you compare that to a buy and hold strategy with a 43.4% capital gain rate at the end. The tax regime could occur as early as January 1. Lawyers and planners are going to be overwhelmed when it hits. And it's just, some of your clients probably haven't even thought about this. They need to start thinking about it. And that's a very, very valuable service you can bring to them. Some of them might be paralyzed to do it. They might be afraid to pull the trigger right now. If you brought up the idea and the client was afraid to act, well, they're going to think you were a smart man or woman when this is over. And they'll at least acknowledge that you were ahead of the curve. I'm of a generation where I remember Gilligan's Island with great fondness. And this is the professor and Skipper and Gilligan sitting there trying to figure out how to get off the island. They didn't have the lifeboat. Don't let your clients get caught without the lifeboat. Obviously, there's a lot here. There's a lot of ways to use insurance to solve some of these problems. Some of these problems are unsolvable. We're just looking at a significantly higher tax bracket. A couple of the studies have indicated that folks earning over $800,000 approximately $30,000. The top 1% of earners are effectively going to earn 18% less under the Biden regime. There's also studies that show that it'll impact GDP by 1.5%. This is not insignificant, but there are some things to be done with planning and opportunities not to be lost, and obviously a market that's really going to need your products going forward. So happy to take questions.
Ed, hi. So what you did not know was this was fabulous. We had some technical difficulties with this session, and it was recorded. It went live about 30 seconds ago. So I don't believe that we are going to have any questions right now. What we're planning on doing is we are going to send out the recording with a link. And what I would like to discuss with you is perhaps offering a bonus session maybe next week or in a few days where we could address Q&A specifically as it relates to your session. So please, I know I'm putting you on the spot.
I'm happy to do it, Kathy. I'm happy to do it. It's always fun. I mean, I love working with life insurance guys. I think they're some of the smartest, creative people I deal with. So happy to come back. We just have to figure out when we can get it on the schedule.
Exactly. So we will go offline and discuss that. For everybody that is who had just perhaps hung in there, or folks that will be listening to this later this afternoon, again, Agency One apologizes for the technical difficulties, but we do have this entire session recorded, and it will be available for everybody's viewing pleasure at their convenience. And we will invite you to ask questions, and we will circle back around with Ed. Ed, you relayed a tremendous information. There is a lot of opportunity for the advisors, and we hope that everybody acts upon the opportunities that are available in a timely manner. So on behalf of Agency One, thank you for listening to this, and we hope that you will tune into additional sessions throughout the month, and fingers crossed, we are anticipating no further technical difficulties. So with that, Ed, I'm going to say thank you, and we will talk soon. Take care.
Thanks for having me, Kathy.
Take care.